Hi everyone. So welcome to the next lesson of auditing and assurance lecture. Now you have discussed up to ISA 500 audit evidence. This is the lesson we discussed previous week actually, right? When we were conducting physical lectures, this is where we stopped. We started discussing ISA 500, which is all about audit evidence. So we have discussed everything coming under this lesson, but just to recap what we did in previous weeks, because it would be important for you to understand today's lesson, I will just recap what we discussed up to now. So, you know what do you mean by audit evidence, and you know the difference between sufficiency and appropriateness. Sufficiency means about quantity. Appropriateness means it's all about quality. So we have discussed the difference between sufficiency and appropriateness, and then we discussed about audit procedures, right? What are the audit procedures we are going to do when we are doing an audit? I told you, first of all, we are doing risk assessment procedures. Risk assessment procedures. We are assessing the risk of the client. And then we are doing further audit procedures. In addition to the risk assessment procedures, after assessing the risk, you are doing further audit procedures. So coming under further audit procedures, there are two types. What are those two types? Test of controls and substantive procedures. Right. So these things we discussed. And then we move on to audit procedures. Now, I told you clearly, these are like some categories, right? These are some categories. Coming under risk assessment procedures, coming under test of controls and substantive procedures, we have 7 audit procedures in discussion. How many audit procedures? 7 audit procedures. So those are the real audit procedures, right? So what are those audit procedures? We discussed about inspection. You are inspecting the documents, you are inspecting the physical assets. Or observation. Observing may be a process done by another party. You are observing the process of counting the inventory. Likewise, observation. Or maybe it can be inquiry. You are inquiring the knowledgeable persons about something about the organization. And then confirmation. Confirmation means you are calling confirmations from various other parties, maybe about the debtor balances, maybe about the bank balances. So you are calling confirmations from third parties, maybe from debtors, maybe from creditors, banks, lawyers. Likewise, you are confirming those balances through confirmations. Maybe recalculation. As the auditor, you are recalculating those figures and see whether the mathematical accuracy is there. Recalculation. Reperformance. You are performing, again reperforming a particular process or particular task performed by the client. Maybe you take one bank reconciliation and redo it and see whether the process has been followed. So reperformance. And then it can be analytical procedures. So we discussed about analytical procedures separately as well with the standard, right? You are analyzing, you are seeing whether there are any plausible relationships between financial data, or it can be non-financial data. So I have discussed several examples for those analytical procedures in the class. Right. And the most important thing, I told you, now we have 7 audit procedures, right? We have 7 audit procedures. These 7 audit procedures can be risk assessment procedures, those can be test of controls, or those can be substantive procedures, right? We don't know. So that's why these 7 audit procedures are there. Those are taken as those coming under those categories. It can be risk assessment procedures, or inspection can be a test of control, inspection can be a substantive procedures. So depending on the situation, those audit procedures will be used. So we discussed that part as well. So these slides, one by one, it explains the meaning of these audit procedures. Right. So these are the important things we discussed last week. Plus, we discussed about the analytical procedures in detail. Right. Okay. So moving on to today's lecture. Right. Today's lesson. This is our lesson. Now, when you read the topic, auditing, accounts receivable, and revenue. Now, last week, in the previous weeks, up to now, we understood what are the audit procedures we have to do, right? In common, in general, what are the audit procedures? What are the risk assessment procedures? What do you mean by internal controls? What are test of controls? What are substantive procedures? So coming under substantive procedures, there are two types: test of details and substantive analytical procedures. We have discussed everything. Now, the thing is, what is practically when you go to an audit or when you have to know about auditing, right? Now, if you take the two main financial statements, what are the two main financial statements? Like profit or loss statement and the statement of financial position. Now, in those financial statements, you can see different line items. Different line items. Now, if you take the income statement, profit or loss statement, you have sales, you have cost of sales, you have other income, you have expenses. Those are the main categories. When it comes to statement of financial position, what are the things included? You have non-current assets, you have inventory, you have trade receivables, you have bank loans. Likewise, assets, liabilities, equity items are there. Now, when you are going to do an audit, you have to perform audit procedures for each and every line item. In auditing, you call it captions. So you have to do audit procedures for each and every caption. You have to do audit procedures separately for sales, separately for cost of sales, separately for expenses. Likewise, you are doing audit procedures. Now, if you take assets, liabilities, equity, you are again performing those specific audit procedures. So now, this lesson, we are talking about one major profit or loss statement caption, which is revenue, and then another major and interrelated caption in statement of financial position, which is accounts receivable. So in this syllabus, in this lecture series, we are not in a position to discuss audit procedures for all captions, right? We can't do that, but we will be uploading the documents, including all those audit procedures for your reference. So you can further read those documents and understand what are the possible audit procedures we can perform for different captions separately. There are differences. Right. So we'll do the discussion with revenue and accounts receivable. That's the main focus in this lecture. Right. First of all, sources of accounts receivable. Now you need to know this one. What are the sources of accounts receivable? Now, if you take the statement of financial position under non-current assets and current assets, you have separate line items. Just imagine a statement of financial position. Now, coming under current assets, you have accounts receivable. Accounts receivable balances that should be received by the company. Accounts receivable. Now, there can be different account receivables, different nature accounts receivable in this line item. So as the auditor, your first task, let's say you have been allocated to do the audit procedures for accounts receivable. Now, what is your first task? First of all, you need to know what is included in accounts receivable. Maybe what are the line items? What is the breakup of this total balance, accounts receivable balance? Because on the face of the statement of financial position, you can see only one figure. So you need to know what is the breakup. Right. Now, when you go in deep and analyze what is included in accounts receivable, sometimes you will find these these sources. What is the first one? What is the first source of accounts receivable? Claims against customers from sale of goods or services. See, this is the major source of accounts receivable. Customers from sales of goods or services. Basically, it talks about trade receivables. It talks about trade receivables. Since the business or the company has sold goods or services on credit basis, what has happened? Now there are debtors. Now there are trade receivables. That is the main source coming under accounts receivable. That is the main source, trade receivable. So you can write down this is trade receivables because of trading, because of selling things. Apart from that, that is the major source. Apart from that, there can be loans to officers or employees. Maybe the company has given staff loans to the employees. Now those balances are receivable. Loans to subsidiaries. Maybe the company has different subsidiary companies. This company has given loans to those subsidiaries, intercompany loans. So those balances are receivable. Claims against various other refunds. Sometimes you have deposited some amount for different purposes and it's a refund. You can refund it. So that those are receivable balances. Claims for tax refunds. Some tax refunds are there. Receivable balances. That is also coming under accounts receivable. Advances to suppliers. You have paid advances to suppliers. So those balances are becoming accounts receivable. Right, so those are the main sources usually you can see in a balance sheet, in a statement of financial position. Now, not all these sources will be available when you are doing an audit, but definitely most of the time, if the companies, unless the company is not doing credit sales, definitely you will find trade receivables, right? Okay, so those are the sources and shown on balance sheet. That means a statement of financial position at net realizable value, right? Now let's say trade receivables. If the trade receivable balance is there, as you clearly know, you have to provide for provisions for doubtful debts, bad debts, right? After making the provisions, after deducting those provisions, you can have the net realizable value and those balances will be there. So say similar concept goes to every other accounts receivable. So that's why it says those balances will be kept at net realizable value in simple terms. Right. So those are the sources. And now the next slide is about audit risk of receivables. Now we are talking from the perspective of auditor, right? So what is the audit risk of these receivables? Audit risk significant. Now, when it comes to accounts receivable, it says audit risk is significant. Why significant? Many incidences of fraud have involved overstatement of receivables and revenue. Now, our main focus here in these receivables, our main focus is trade receivables because trade receivables is the major component of accounts receivables. Now, here it says overstatement of receivables and revenues. Why? Now, let's say revenue and trade receivables are interconnected, right? I hope you can understand that. When the credit sales are increasing, revenue increasing, and at the same time, accounts receivable, that means trade receivable balance increases. Now, what if the company's top managers want to show a high amount of sales during a particular year? They will maybe fictitious sales, they will record fictitious sales in the sales account, right? Those sales have not actually been happened, but they will record those things due to different reasons, maybe because of a bonus or something like that. When they are manipulating the sales figure, revenue figure, and increasing it, what will happen to the trade receivable balance? Since obviously you are not receiving cash, you can't debit cash, usually you will debit trade receivables. So in that case, if you are trying to manipulate the revenue figure and show a pretty good value in revenue, definitely there will be an impact on trade receivables. So that is why audit risk is very high when it comes to these accounts receivable in total, because there can be frauds happening with those overstatement of these balances. That is the first thing. Because of that, audit risk is high. There's a possibility that there will be material misstatements. Audit risk. Revenue recognition may be based on complex accounting rules. Okay, now think about revenue recognition. I hope you have studied SLFRS 15, right? In your first year, you have studied. Now, if you just refresh your memory, when it comes to revenue recognition, there's a specific point with those performance obligations. Now, I have the experience of revenue. Now, when it comes to auditing, some companies, revenue recognition point is very critical, very tricky, right? We can't exactly say the point where the revenue should be recognized. In some organizations, it's very clear when the goods are sold or something like that. But sometimes it's very clear. It's not very clear because of those complex accounting rules and everything. Now, sometimes think about a software development firm. Software development firm. Maybe that company is developing softwares, and after that, that firm is providing different other services. What are the services? Maybe giving updates, maybe maintenance services, different things are there. Now, we can't exactly identify as auditors now whether the performance obligation has been fulfilled, whether the revenue should be recognized in this point. It's very tricky. So that's why it says revenue recognition may be based on complex accounting rules. The processes are very complex. So in those companies, based on the nature of the service or the goods providing, sometimes it's difficult. When the revenue recognition point is difficult to understand and the processes are getting really complex, what about the audit risk? Audit risk is high. Why? There is a high chance that there can be material misstatements. There's a high chance that there can be frauds, errors. That's why audit risk is high. So remember that example I gave you. And then third one, receivables and revenues are usually subject to valuation using significant accounting estimates. Sometimes revenue and both receivable balances, those are with significant estimates, significant accounting estimates. Now think about a construction company. When it comes to construction companies, those companies are invoicing, preparing invoices based on the percentage of completion. Let's say it's a big construction project, but there are different stages or the phases. So they are doing us invoices. They are giving us invoices based on the percentage of completion. So that percentage of completion, we can't exactly say. It's all about estimates. It's all about judgments and estimates. So when there are significant accounting estimates involved in the revenue recognition or the revenue measurement and the receivables, audit risk is high. Because as auditors, we don't know whether they have done the correct estimate, most suitable estimate. There can be issues with those things. So that is why again, audit risk is significant in these areas. So remember, these are few like three examples where the audit risk is significant because of both revenue and receivables. Right. Okay. Now moving to the next slide. Objectives for the audit of receivables and revenue. Now, what are the objectives of this auditing, both accounts receivable and revenue? Now, why we are talking these captions together? I'm telling again because these are interrelated, right? We are focusing on trade receivables. Trade receivables happen because of revenue, so those are interrelated. Now, in audits also, most of the time, not every time, most of the time, the person who is doing revenue will be doing audit procedures for receivables as well, because that is easy, right? When you are checking revenue with the customers and everyone, those customers will become the trade receivables as well. So that's why the same person is doing both captions together. Right, all right. Now, what are the objectives of auditing these receivables and revenue? Number like A, use the understanding of the client and its environment. Why? To consider inherent risk, including fraud risks related to receivables and revenue. Now, before starting the audit procedures, what is the first thing you need to do? You have to understand the client and its environment. Why? When you get to know about the client's nature, client's past history, what has happened in the previous audits, what are the new market dynamics, everything about the client and the environment, you can assess whether there's an inherent risk, whether there is an inherent risk in these revenue and receivable balances. Let's say you are going for a construction company. Now you have to do audit procedures for revenue and receivables. Inherently, there's a risk. Why? You know that there are complex processes for revenue recognition. There can be significant estimates involved in deciding percentage of completion when invoicing. So when you go to that industry, when you go to that client place, you get to know about from the nature of the product, there can be inherent risks. That is the first thing, right? By understanding, you see the inherent risk. Second one, obtain an understanding of internal controls over receivables and revenue. When you go to the client place, now you get to know, now you understand what are the internal controls placed for revenue and receivables. So you have to see what are the controls placed by the management. And then assess the risk of material misstatements and design test of controls and substantive procedures. Now, after assessing, after getting to know about the client, environment, their internal controls, now you can risk assess. You can assess the risk of material misstatements. Now you have to design what are the test of controls I'm going to do, what are the substantive procedures I'm going to do, right? So what are the 6 steps? Substantiate the existence of receivables and the occurrence of revenue transactions. Now this is all about the assertions. We have discussed assertions previous weeks and also from throughout these sessions, right? Assertions. So what are the assertions we are going to cover through these tests of controls and substantive procedures? Substantiate the existence of receivables, occurrence of revenue. So I hope you are very clear about the assertions. So when it comes to assertions, you are using the assertion existence for statement of financial position items, balance sheet items. Existence of receivables. You don't say existence of revenue. You say occurrence of revenue, right? So you are checking that. And then establish the completeness of receivables and revenue. You use completeness assertion for both revenue and receivables. And verify the cutoff of revenue transactions. Now, existence means actually whether the receivables are actually existing as at the end of the day. Occurrence means whether revenue transactions have been actually occurred during the period or whether they are fictitious transactions. So, occurrence. Completeness means whether all the transactions that should be recorded have been recorded. There were 150 transactions, revenue transactions. Whether all these 150 transactions have been recorded. Completeness. Cutoff. Whether these transactions have been recorded in the correct accounting period. Right? Is it 2023 or 2024? Cutoff. Determine that the client has rights to record receivables. So when you are checking whether your client has the legal right to record these balances as receivables, whether they are true debtors, and establish the proper valuation of receivables. That means you have done the valuation correctly for receivables and the accuracy of revenue transactions, whether you have recorded the revenue transactions with correct amounts. And then last one, determine that the presentation and disclosure of receivables and revenue are appropriate. So you are checking for presentation and disclosure as well. So with those things, right, you are trying to implement those assertions. You are going to check the assertions, right? Now the internal controls. Now I told you, you need to understand the internal controls over receivables and revenue. What are the components you are going to see coming under internal controls? So you have discussed those components separately in previous lectures. But if I just mention control environment, that is one component coming under internal controls, right? Control environment. So what is included in control environment? It's basically important because of risk of intentional misstatements of revenue. You have to see the control environment. You have to analyze. You have to understand what is the control environment in this company. What is the support taken from the top management? Whether top managers of this company are very keen about the internal controls placed, whether they are doing any malpractices, something like that. You need to understand the control environment. So, commitment to integrity and ethical behavior. Whether this company is valuing the ethics, whether they are following the ethics, whether there is a code of conduct for them. Likewise, what is the commitment to integrity? Whether they are very afraid of doing mistakes, afraid of breaching integrity. You are checking those things. You can understand. Now, let's say when you are going to a client place, like when you go to a client place, by looking at them, by talking to them, by being there for a few days, you get to know about their culture. So culture is all about the control environment. Sometimes they are not doing any mistake, or sometimes there are mistakes, but they are ignoring it. So a client is saying you, okay, that's a small mistake. No, that's the attitude they have. So you can get to know about the control environment, right? So sometimes there can be top managers, they are very keen about the small mistakes done by the lower level employees. They don't want any mistake. They want those neat and tidy documents, reports for them. So that's the control environment they have. Right. So the independence of board and audit committee, that is the higher level. Board and audit committee, whether they are actually independent, whether they are making decisions independently. That is the control environment. Appropriate structure and lines of responsibility, whether there are specific given lines of responsibility, whether there is a good scope for them. Those are the control environment things. Commitment to recruit, develop, and retain competent employees. If they are recruiting more competent, skilled people, that means they want to get the work done properly. That's why they are recruiting good people. If they are not thinking about those things and they are just recruiting someone who is very familiar or a relation like that, they are not thinking about the quality of the work, right? That is control environment. And holding employees accountable, those are the like things or characteristics we have to see when it comes to analyzing control environment. I hope you are clear with those things because you have already discussed these things. And risk assessment, that is a second component. Risk of misstatements of revenue may be high based on its nature and complex rules regarding revenue recognition. We discussed that part, right? I told you the audit risk can be high when it comes to revenue and receivables because of the nature, complex situations, significant accounting estimates, and everything. Right. And then control activities. What are the control activities that can be there when it comes to revenue and accounts receivable? Now, here the control activities are not mentioned, but the situations or the instances where we need to have internal controls, where we need to have control activities are mentioned. When preparing sales orders, that is the major point. We have to record sales or we have to initiate the sales when we are receiving an order. First of all, there should be an order, right? That is for us sales order. There should be a sales order. So when preparing the sales order, what are the control activities they are following? Whether the preparation of sales order, whether that task is done by few people, right? Whether that task has been segregated between few people, you call it segregation of duties. Whether those things are there, whether the approvals have been cut down to different levels. Above 1 million, this person has to sign. About 5 million, these two people have to sign. Likewise, different authorization levels, approval levels. So those are the controls, right? Control activities. So you have to see in different situations like this, different tasks, whether they have put controllers, whether they have control activities. So preparing sales order, approving credit. Now, when there are credit sales, what happens? We are giving our goods on credit. So we are not receiving the payment. When in a company, when there are credit sales, before making the sales, we have to approve the credits. We have to approve the credit limits. The company has to decide how much of a limit we are allowing for one particular person, one particular credit customer. Is it 1 million? Are we going to sell goods on credit basis up to 1 million? Or are we going to sell goods on credit basis up to 100,000? There can be different limits based on different factors. If it is a well-known, old, very good customer, we will give them a higher credit limit. If he is not making payments on time, something like those things, we are giving a low value of credit limit. So approving the credit limit is very important. Before making the sale, before initiating the sales, we have to approve the credit. So when approving the credit also in that task, there can be internal controls. So what are the internal controls we can have? Maybe the approval is done by someone else, authorized personnel. Maybe data entering and doing those credit checkups, those are done by another party. Likewise, there can be different activities, control activities. And then issuing merchandise from stock. That means you are issuing the stocks from the warehouses. When you are issuing the stocks from the warehouses, there should be approved documents, there should be approved sales order, there should be approved dispatch notes, there should be approved other documents, maybe different controls. So you need to see what are the controls they have in their organization with regards to these activities. Shipment. When making a shipment, what are the controls? When billing means preparing the invoices, invoicing. When invoicing, whether there are controls. Maybe at the point of invoicing, they have to check the sales order, what is the amount of goods we have actually dispatched. So goods dispatch note, we have to compare those things, then only we are preparing the invoice. Now think about this situation. Can we make the invoice just based on the sales order we got from the customer? Based on the customer order we are making the invoice. What if we have dispatched more expensive stuff, right? We have to change the prices and everything. Based on the sales order, blindly we can't prepare the sales invoice. Maybe there are discussions between the customer because we are running out of stock. The amount, the stock requested by the customer. So we have given a different product at a higher price. So can we just prepare the invoice based on the sales order? No, we have to get all those details, all those agreements we made after that. So that is why we have to check everything before invoicing, right? Sometimes the customer has ordered 1,000 units, but we have dispatched 500 units, right? They have requested ordered 1,000 units, but we have dispatched 500 units based on the confirmation. Now, can we prepare the sales invoice based on the sales order for 1,000 units? No, we can't. We have to say how many units we have actually dispatched. That is 500 units. So those are the controls we need to have. And then invoice verification, maintenance of control accounts, maintenance of customers' ledgers, approval of sales returns and allowances, who is approving the sales returns, who are recording sales returns, what is the process, authorization of write-offs of uncollectible amounts. That means basically bad debts. How are we going to make the bad debts? Who is approving, right? So those things, for these instances, we need to have control activities. And after that, we have to monitor these control activities as well. So these are the main things we have to consider when talking about the internal controls. Right. Now, there are few documents actually in this revenue cycle. What are the few documents we can use? Now, when we are getting a sales order, it's an order from our perspective, our company's perspective, it's a sales order. From the customer's perspective, it's a purchase order for them, right? They are purchasing something. We are selling something. So that's why we say customer purchasing, that purchase order. For us, it is a sales order. That is the document. For sales, sales order. We are converting the purchase order as sales order. For shipping, we have bill of lading. What do you mean by that? Maybe the ship, the courier, is giving us a document, issuing a document called bill of lading, ensuring that they have received the cargo to be shipped, right? Cargo to be shipped. They have received the cargo. They have received the stock to be shipped. That is bill of lading. And then when it comes to billing, we have the invoice. That is the document. Receiving cash receipts, you have the control listing. Authorizing adjustments to accounts receivables, we have credit memo. Let's say based on the price differences or something errors, you need to deduct or you need to reduce the value of an invoice. You have already sent the invoice to the customer. Now, to reduce the amount in the invoice, you are issuing a credit memo to reduce the amount. Maybe you have sent a different good type. So the prices are different. Prices should be reduced. So you are using a credit memo for them. Likewise, these are the main documents we can find when it comes to a revenue cycle. But practically, when it comes to a practical organization, there can be other documents as well. Right. So if you can see the sales system, it starts from this taking orders, right? You are taking the orders and then you are having document. You are keeping the documents of the order. You are recording the order. And then you are making the order, maybe manufacturing, right? Making the order. After that, what happens? Raise goods, dispatch note. You are ready to dispatch the goods, so you are making the goods dispatch note. After that, you are dispatching the order. You are sending the order. Give me a second. Right, likewise. Now, right. So you have taken the order, you documented it, you made the order, you raised the goods dispatch note, and you have dispatched the goods as well. And at the same time, now the finance department is raising the invoice. They are raising the invoice by looking at the by looking at which documents. Basically, the sales order and the goods dispatch note. What is the amount they have requested or ordered? What are the amounts we have actually dispatched? What are the prices? So what is the revenue? So they are raising the revenue, account for revenue. You are recording the revenue in your books, and then you are sending the statement, and then you are chasing the payment, right? You have to collect the amounts, dispatching the invoice, and then receiving the payments. So those are the things. Usual sales system, right? You need to understand the process. Now, in any company, when you go to do audit procedures for revenue or any other thing, first of all, you need to do a system study. There can be different terminologies for that. You have to do a system study. You have to study the system first. You need to know what is the process, who is approving, what is the starting point, what is the ending point, What are the documents involved? Who are the personnel involved? What are the authorization points? Everything. You need to document it, right? You need to document the whole process like this, maybe like a flow chart. See, this is a flow chart. Maybe using the start option. After starting from customer, you are receiving a purchase order. Input sales order data. By looking at the purchase order of the customer, you are preparing the sales order. After that, before initiating the sales, you need to approve the credit, as I mentioned you, right? If that person has already exceeded credit, you can't initiate the sales and go on. That's why before initiating the sales, you need to approve the credit. And then it goes to customer files as well. Because if you have approved 1 million or 10 million credit limit for a particular customer, you need to record that in the customer file. So in organizations, there are separate customer files. Sometimes physical customer files can be there, but most of the organizations now they have soft copies, right? Everything is recorded online or in softwares. Yet they are recording everything: name, contact numbers, the sales history, credit terms, everything. And after that, what happens? Now the credit terms or the credit periods or the credit limits are approved. Now approved sales order file. It goes to approved sales order file. What happens after that? You are releasing the goods for shipping. So you are taking the goods, input sales data, and generate bill of lading. So you are shipping the goods through this line. You are shipping the goods. So goods have been dispatched to the customer, right? And at the same time, you have the bill of lading issued by the carrier, right? And then shipping file, those things are there. So don't think about this sales system flow chart as one traditional one, because there can be so many differences in your client. When you are doing an audit, let's say if you are doing audit, there can be different things coming into this process. This is just a traditional, a typical sales system, right? This is how, these are the major things. And in between those things, in addition to those things, there can be different other components coming, right? So you need to know the system. After that, what happens? Risk assessment for the audit of receivables. Now, what are the risk assessment things? Use the understanding of the client and its environment to consider inherent risk. As we discussed, you are understanding the environment, you are understanding the client. And then what do? You obtain the understanding of the internal controls. You are talking about the internal controls now. Okay, what are the internal controls placed? Now you know the instances where you need to have internal controls. We discussed that. And then assess the risk of material misstatements and design further audit procedures. After getting to know about these internal controls, now you are assessing the risk of material misstatements, and then you are planning what are the plannings. What are the test of controls I'm going to do? What are the substantive procedures I'm going to do? Right. Those are coming under further audit procedures. So you can refer to previous lesson. Further audit procedures, there are two: test of controls and substantive procedures. Right. Details on understanding the client business. Now, I repeated, right? I told you we need to know the details of client business, basically the client and the environments. So what are the things you need to know? Just quickly see what are the things you need to know. Types of products and services sold. Definitely you need to understand the product type. The classes and categories of the client's customers. Who are the customers? Credit customers, non-credit customers. Different categories can be there. Whether local customers, international customers, that means domestic and international customers, retail customers, wholesale customers, different classifications. Whether the business is affected by seasonal or cyclical demand. Some organizations have cyclical, some have seasonal. Both are the same most of the time, but you need to understand that, or a regular consumer product. Typical marketing policies for the client and its industry. What are the marketing policies? Policies regarding pricing. What is their policy for sales returns? What do they do? Do they give discounts? What are the policies? Extension of credit. Do they extend the credit limit? Normal delivery and payment terms. Everything you need to know about the client. Compensation arrangements that are based on recorded revenue. If there are any bonuses, incentives given on revenue, you need to know that. Why? It is very important because if there are incentives or revenues computed based on incentives or bonuses computed based on revenue, there can be situations where there's a high risk. Why? Sometimes because of the bonuses, managers may manipulate the sales figure. They will try to overstate the revenue because they need the bonus. So that is inherent risk. There's a high risk there, right? That is why you need to know these things. Typical revenue recognition principles used in the industry and their methods of application. So in my company, what is the revenue recognition way? In the industry, what are the things? And also not only these things, in addition to these things, we have to know about the market. What is the market trend these days? Now, when it comes to COVID, you need to understand not only about the client, but about the environment as well. In industry, in the global market, the demand has been dropped for certain products. So not only for your company, not only for your client, in the global market, there can be changes. So you need to know these things. Sometimes there can be a new risk coming into the industry. Previously, it was not there, but there's a new trend now. It is happening in the industry. You need to know these things. That's why you need to read, you need to see the latest news articles. Those are very important, right? Okay. Now, fraud risk related to receivables and revenue. Not only the inherent risk, you need to know about the fraud risks as well. What are the fraud risks? Maybe understand controls established by management to control risk. First of all, you need to see, okay, what are the controls this organization has put to avoid those fraud risks? Determine controls have been implemented, right? They have the controls, but now you need to see whether they have been actually implemented. Response to risks, an overall effect on audit. Alter the design of audit procedures based on your analysis, based on your understanding you taken. Sometimes you will have to think about, you will have to assess what is the overall impact on the audit. Now, based on your understanding, you see controls are not working effectively, controls have not been designed effectively, they have not been implemented well, so there's a high fraud risk. In that case, you need to say, okay, now what is the overall impact on the audit? Do I have to change the audit procedures? Do I have to change the materiality computation? Likewise, you need to see the overall impact on the audit. Alter the design of audit procedures. That's why I told you, you will have to do more pre-performances. You will have to do more confirmations. You will have to do more inspections. So you will have to change the audit procedures. Previously, you only thought of calling confirmations, but now you will have to recomputation, you will have to recompute, reperform, inquire, different, or a combination of audit procedures. So based on the fraud risk, performing procedures to address risk of material misstatements due to management override of internal controls. So frauds are happening because the management has override the controls, right? They have not respected the given internal controls. They have done what they want, right? So that's why frauds are happening, right? Override of controls. So you need to perform the audit procedures very well to address these risk of material misstatements, right? These are the potential misstatements. Now, I didn't give you the examples, right? That's why here everything is mentioned. See, we'll go through few things, right? Potential misstatements coming under revenue. Look at this description of the misstatement. What is that? Recognizing revenue not yet earned. You have recorded revenue, but it is not yet earned. right? Fictitious revenue, that means. So, what is the example for fraud? Recording fictitious sales without receiving a customer order or shipping the goods. Even you don't have a customer order, even. Customers have not made orders, but you have recorded sales and you have not dispatched the goods as well. Still, you have recorded the sales as fictitious sales. That can be a fraud. So, look at this internal control weaknesses or factors that increase the risk of misstatement. What are the control weaknesses? Maybe ineffective board directors, audit committee, or internal audit function. If they are effective, if they are very sound, these things are not happening in an organization. So these things are happening because they are very poor, they are very ineffective. Tone at the top not conducive to ethical conduct, undue pressures to meet sales targets, something like that. Maybe managers themselves trying to increase the sales by recording fictitious sales just to meet the targets, just to meet the sales targets and earn the bonus, something like that. So those are the internal control weaknesses. Look at another one, errors. What are the examples for errors? Now this is a fraud. Recording fictitious sales means a fraud, intentional. What are the errors? Recording sales based on the receipt or receipt of orders from customers rather than the shipment of goods. So this thing I explained you. What if you are raising the invoice based on the sales order? That is wrong. You have to compare it with the GDN. That means goods dispatch note as well. So that is not maybe a fraud, maybe it can be an error or inaccurate billing and recording of sales. So you have errors of recording the values. Recording cash that represents a liability as revenue. Okay. So ineffective billing process in which billing is not tied to shipping information. Those are the reasons. Ineffective controls for testing invoices or ineffective input validation checks and computer reconciliations to ensure the accuracy of databases. Those are the issues. Or maybe inadequate accounting manual, incompetent accounting personnel. That's why they are making errors. Maybe they are not skilled, they are incompetent, there's no accounting manual for the work. Maybe the billing process is ineffective. They are not checking other documents. Likewise, there can be issues. So in these slides, one by one, what is the misstatement? What are the examples? And what are the reasons? See the second misstatement, early recognition of revenue. You can say cut-off problems. Sales has been actually recorded, actually happened in 2024 January, but you have the company has recorded the sales in 2023 December. Early recognition, cut-off issue, holding the sales journal open to record next year's sales as having occurred in the current year. So those are intentional things. Just to increase the sales this year, you are recording next year's sales as well in the current year. So what are the internal control weaknesses or the factors affecting these things? Ineffective board of directors, audit committee, or tone at the top not conducive to ethical conduct. Those are the reasons. The same reason is repeating here. And what are the errors now? Recording sales in the wrong period based on incorrect shipping information, right? So these things can happen. Ineffective cutoff procedures in the shipment department. Those are the reasons. So you can see the way it has been written. You have the misstatement, you have the examples, and the reason is given. Go to the second one. Recording revenue when significant uncertainties exist. There are significant uncertainties, but still you have recorded the revenue. Overestimating revenue by underestimating the effects of customers' rise to return goods. There's a high chance the customer will return the goods. There's a significant uncertainty about it, but still you have recorded the sales. Again, the same reason, right? What are the errors in this case? What are the errors that can happen? Recording sales when the customer's payment is contingent upon the customer receiving financing or selling the goods to another party. You are unsure, you have a significant uncertainty, but you are not respecting that, you are just recording. Here it's not intentional, right? It's an error. So, what are the issues? What are the reasons? Aggressive attitude of management towards financial reporting, or maybe incompetent chief accounting officer. Because of his incompetency, he was not able to uh, face this significant uncertainty. He was not able to face that situation. They just report. So those are the errors. Likewise, recording revenue when significant services, or you can say performance obligations, still must be performed by seller, still must be performed, but still revenue has been recognized. So you can read out what is the fraud and the error. Look at the last one. Yes, last one. Overestimation of the amount of revenue earned. Maybe it can be a fraud like overstating the extent of performance on several contracts by a computer software company, or error, overstating revenue earned due to unintentional misappropriation of revenue, right? Misapplication of revenue recognition policies associated with complex sales contract. Maybe you are overestimating it because it was difficult to understand the sales revenue recognition point. There can be issues like that. So that is an error. It is not intentional. So unclear revenue recognition or lack of training competent personnel, these are the reasons. So here I hope now you can again read and understand what is mentioned here. Misstatements, what are the examples? It can be a fraud or it can be an error. What are the reasons? Okay, now if I go back and like, yes, I hope you can see this slide now. If I go back and show these steps again, first of all, you understood the client and its environment and what are the inherent risk and fraud risks. And then you understood the internal controls. And then you assess the risk of material misstatements and design the audit procedures. And D here, this is the continuation. D, perform further audit procedures. So you are performing the audit procedures now. What are the two types of further audit procedures again? Test of controls and substantive procedures. So the first one, test of controls. We are going to talk about test of controls. So what are the test of controls you can do? What are the things you can do to test the control? Examine significant aspects of a sample of sales transaction. Maybe you are selecting a sample and checking things. We'll see the significant aspects in detail later. Compare a sample of shipping documents to related sales invoices, just to see whether the sales invoices have been reconciled with the shipping documents, goods dispatch notes, right? Whether they have actually reconciled it. Maybe you can review the use and authorization of credit memorandum. So if the company has actually approved the credit limits and followed that procedure, followed their internal controls, there should be evidences for the authorization. Maybe a responsible party has signed, like checked, date, signed. Likewise, you can see the evidence. So you are reviewing the authorization of credit. Reconcile selected cash register tapes and sales tickets with sales journal. You are checking everything together. Maybe you are testing the IT application controls, examining evidence of review and approval of revenue estimates. Revenue estimates have been done, maybe percentage of completions and everything, but some responsible party should approve it. So, as the auditor, you go and check whether that other party has reviewed it, signed it, as mentioning signed or checked, right? That is the test of control. And then, if necessary, revise the risk of material misstatement based on the results of test of controls. Let's say now, coming under further audit procedures, you are doing the test of controls. After doing the test of controls, you realize even though they have internal controls, they have not been implemented very well. There are so many issues with the controls. Now what to do? You will have to revise the risk of material misstatements. You will have to do more what? Now, test of controls have failed. Now, you have left only substantive procedures. Now, because of that reason, you will have to do more substantive procedures. You are revising the risk of material mistakes, right? That is the logic behind this. So, why I didn't explain these things in detail? Because there are in detail. What are the controls? See, what is the control in the client organization? What are the typical test of controls we can do as the auditor? And what are the assertions these tests of controls are covering? Everything is here. We'll discuss few things, right? Then you can read and understand. Look at the first one. Maybe they have segregation of duties over sales and collection of receivables. One person is handling sales, that person is not doing the collection of receivables, another person is collecting the receivables. Segregation of duties. Now, what is the test of controls for us to do as the auditor? Observe and make inquiries about the performance of various functions. Maybe you can see when you go to the client place, you can see this person is uh, doing the sales, this person is collecting the debtor balances. So you can observe the process whether they are actually doing it, right? Whether the guy who is responsible for debtor collection is recording the sales as well. So you can observe it. What are the assertions you're going to cover? Occurrence, existence and occurrence both, because receivables and revenue both involved here, existence and occurrence. And you can completeness, rights and obligations, valuation and the accuracy. Maybe you can cover all these things, but you can't just have this one, right? You have to do more, but you can cover these assertions. Look at the second control. Match sales invoices with shipping documents, purchase order, and sales order. See, when you are issuing a sales invoice, you have to compare it with the shipping documents, goods dispatch notes, purchase order, and sales order. Purchase order means the order you took from the customer. For them, it's a purchase order, and then it becomes the sales order for you. You are checking all these documents. What is the amount they have requested? What is the amount we have recorded in the sales order? What is the amount we have dispatched? And then what is the amount we have invoiced for? Right? How can we test this? Select a sample of sales invoices and compare details to shipping documents, purchase order, and sales order. So by doing this, you can cover occurrence, not existence. Occurrence, cut off, because you can check the dates as well, rights and obligations. You have the right to record that sales by you have the genuine sales order, and it talks about the accuracy as well. You can confirm the value. Likewise, I hope now you can understand the style of this, right? Review of the clerical accuracy of sales invoices by a second person. A second person is checking the accuracy of the sales invoice. What is that? Select a sample of sales invoices and examine them for evidence of second person review. Now, if a second person has checked the clerical accuracy of sales invoices, right? If a second person has come and checked the mathematical accuracy, then there should be evidence. That second person should sign it and say that checked with the date maybe. So you are selecting a sample of sales invoices and examine them for evidence of second person review, whether a second person has actually reviewed it. What is the assertion you're going to cover? Accuracy, because the second person checked the accuracy of the value. Right. So obtain credit approvals of sales prior to shipment. Before shipping, you have to approve the credit limit. Make inquiries about credit policies, select a sample of sales transactions, and examine evidence of credit approval, whether there are credit approvals for each and every invoice. So, occurrence and again the accuracy. Likewise, maybe mail monthly statements to customers and follow up on errors reported. Monthly, you are sending reports to your customers, your debtors. Observe and make inquiries about the mailing of statement and review evidence of follow-up. You need to follow up them as well. So those are the controls. See, controls and test of controls. You have so many examples. Reconcile bank accounts monthly. Use control listing to control cash collection. Use budgets and analyze variances from actual amounts. So what is that test of control? Examine budgets and evidence of follow-up on variances. Maybe you are not doing the variance report again. If you do it, what is that? Maybe the variance report has been prepared by the customer. You are going to do it again. What is that? Reperformance or recalculation. It's a report, so recalculating the variance. So you are not trying to do recalculation here. It comes on the test of details. You are just trying to see whether they have prepared the variance report as the control says. That is test of controls. You are checking the test. You are testing the control. You are checking the control. Use pre-numbered shipping and billing documents and account for the sequence. Remember, sequential numbering. When it comes to bills or when it comes to any document, there can be sequential numbering. There can be a numbering system. That shows the main assertion we are going to cover is the completeness. Because if one invoice or if one number in between the order is missing, that means that is missing. We have to find out why it is missing. Completeness is not there. If all these revenue records are being recorded, completeness is there. Likewise, use credit memoranda for authorization of adjustments to sales and receivables. If you have to reduce or change the values, you need to use credit memorandums. So you can select a sample of credit to customer accounts and inspect credit memorandums and other supporting documents. Likewise, you can write many controls in the revenue cycle and with regards to trade receivables and understand what are the test of controls and what are the assertions we're gonna cover through these things. Right. Moving on to the next step. E. Now previously we discussed about D. Now E. Perform further audit procedures. Coming under that, we discussed test of controls here, substantive procedures. Substantive procedures. What are the substantive procedures we can do? Obtain age trial balance. What do you mean by age trial balance? That is aging report. I'll show you aging report, age trial balance of trade accounts receivable, and analysis of other accounts receivable and reconcile to ledgers. Basically, you get the aging report, debtor or trade receivable aging reports, and you can analyze it. That is substantive procedures. Confirm receivables with debtors. You are calling external confirmations from the trade receivables, right? That is confirming. Review year-end cutoff of sales transactions. You are reviewing the cutoff. How to do the cutoff test? Your cutoff is 31st December 2023. Maybe you are taking the last 10 or 20 transactions happened in 2023 and you are taking the first 10 or 20 transactions happened in 2024, right? Last 10 transactions in 2023, first 10 transactions in 2024. Now you check all the invoices and see the dates and everything, right? If there are any issues, now 2023 have been recorded in 2024 or 2024 have been recorded in 2023, there are cutoff issues. So that's how you check the cutoff test. Another substantive procedure. Perform analytical procedures for accounts receivable and revenue. Now, the previous lecture, I explained you how to do these analytical procedures for revenue, right? With financial data, non-financial data. So you can perform analytical procedures. Review significant year-end sales contracts for unusual terms. When you are doing when you have the balance. Now, when you are doing the audit procedures for sales, first of all, you get the sales report. You get the detailed sales report. What is the date? What is the sales invoice number? Who's the customer? What is the amount? What are the goods? What is the amount? What is the unit price? Everything you have in the sales report. That's a comprehensive, very bulky report. Transaction wise, you need to have those things, right? They are using Excel or any other software. You can find out whether there are significant year-end transactions. Sometimes if there are any bonuses or compensations are related to sales targets, managers may be doing big sales. They are doing big sales towards the year end. Why? They want to increase the sales. It's on credit as well. They are selling more and more goods on credit. So what happens, right? Significant year end sales can happen just to cover the sales targets. So you can see bulky, unusual, big amounts towards the year end. That is one thing we do as auditors. And then test the valuation of receivable, computation of interest income, interest receivables. Maybe you have to take all the debtor balances and you are computing expected credit losses. Basically, you have to adjust it for bad debts and the allowance for doubtful debts. So you call it as per the standards impairment, right? Expected credit loss computation, ECL computations. So you have to test the valuation after redoing everything. If you are redoing the ECL computation, that is recomputation, right? And evaluate the propriety, appropriateness of the client's accounting method for receivables and revenue, whether they have done it as per the accounting standards and everything. Evaluate accounting estimates related to revenue recognition. So I told you there can be estimates involved. So you are checking, evaluating whether the estimates are reliable, whether they have done it correctly. Determine the adequacy of client's allowance for uncollectible accounts, that is, allowance for doubtful debts. Ascertain whether any receivables have been pledged, right? You have to see. Now, you call it factoring, right? You are pledging your receivable balances. And then investigate any transactions with or receivables from related parties. There can be related subsidiary or parent companies. So you have to see whether there are any related party transactions are there. Evaluate the business purpose of significant and unusual sales transactions. You have to see using Excel or whatever software, you have to analyze whether there are any unusual transactions. Whether transactions happened in Saturdays, Sundays. Saturday, Sunday, the company is not working, maybe. But there are transactions happened in Saturdays and Sundays. So you can do those things with the date checkings and everything. Unusual things, different things. So likewise, and finally, the evaluating financial statement presentation and disclosure. So when you are recording revenue in the annual report, if it is a consolidated financial statement, maybe you need to show the revenues in a separate note with all those classifications, maybe segment wise, product wise, not detailed, but you need to show some breakdown. So likewise, you need to see all these things. So after taking the controls, after doing the test of controls, you are moving to substantive procedures and you do everything, right? You do everything. Mainly, you are vouching, you are inspecting the documents. You have to select a sample from the sales report and you need to see. You need to match whether the sales invoice is there and the relevant sales order, purchase order, or sales order, and the goods dispatch note is there. What do you call it? You call it three-way matching. Sales invoice, goods dispatch note, and the sales order. You check whether all these documents are there. You are checking the credit limits, credit approvals, and everything. You are checking, you are calling confirmation from debtors. You are not calling, you are recomputing the impairments. That means allowance for doubtful debts. Likewise, you are doing so many things, right? Okay, so this is an example for aging analysis. Like this is a very small aging analysis. In a large organization, there can be so many debtors, right? Now see, there are only 4 debtors in this customer name column. and the total receivable balance. Now, as at 31st, 2019, this is the old one. What is the breakup? $130, $130,000 is the total value. There are different balances. And what are these buckets? You call them buckets. First bucket, second bucket, third and fourth. These buckets are for different timing periods. Now the current means 0 or the final value. That means past due 1 to 3. I'll tell you this first. Past due 1 to 30 days. That means the customer has exceeded the credit period by 1 to 30 days. Overdue. Past due means overdue now. Current means within 0 to that given credit period. Maybe credit period is 2 weeks. It is in the current bucket. Why? There are no issues. It is this still this balance is in the correct credit period. It is not overdue. It is in the correct credit period. After that, what happens? After that given 2 weeks credit period, it goes to the next bucket. What is that? 1 to 30 days due. Now it's late. What happens after 1 month? Now 1 month late, it goes to the second bucket. That is 31 to 60 days due. That is 31 to 60 days delayed. Still, that person has not made the payment. It goes to the next bucket, 61 plus days due. That means more than 3 months due. Likewise, you have different buckets. So based on the date of the sales, right? Based on the date of the sales and the given credit period, those balances will be they will be changed based on the bucket, right? Now here, ABC company total value is 62,000, but 59,000 within the credit period. Those balances are not overdue within the credit period, current bucket. But 3,000 something, it is past due by 1 month, 1 to 30 days. Here, 18,000 by extreme company, more than 3 months, more than 61 days, more than 61 days old now. Is there a high chance of not being able to collect this amount, or is it okay? There's a high chance this balance will not be able to be collected. So that is why we are providing for allowance for doubtful debts in these situations. So you can compute allowance for doubtful debts, impairment easily using these buckets. Definitely you need to have these buckets for the ECL computation. Based on that only you are providing. So you will have to provide more for 18,000, right? Because there's a high chance we are not getting that balance. But for 3,000, there's a less chance. We have to do a big provision because there's a high tendency we can collect it, right? Something like that. Here, main corporation total is 48,000. It is still in the current bucket. It is still in the correct credit period. It is not past due. Likewise, this is how you read an aging analysis, right? Aging analysis. Right. Now here again, substantive procedures. What are the procedures for receivables and revenue? Given, what is the important thing? Assertions are given. Relevant assertion is given. Look at the first one. Maybe you are obtaining aged listing. Aged listing means aging analysis of receivables and reconcile to ledgers. Whether the debtors are in the correct bucket. You have to check. Using a sample, you have to check whether maybe using ABC company's invoices based on the date, based on the credit period, you are checking whether the buckets are correct. Bucket values are correct, right? So reconcile with the ledgers. Well, what are you doing? What are you covering? The assertion is valuation, maybe. Valuation and accuracy. Obtain analysis of notes, receivables, and related interest. So you are recomputing again. You are rechecking the balances, valuation. Inspect notes on hands and confirm those not on hand. Existence. Confirm receivables with debtors. That means you are calling confirmations from the debtors. What are you going to cover? Existence. If the debtor has confirmed the balance, that means actually there's a debtor balance as at this date. Existence is covered. So existence, maybe occurrence because it is a sales, and rights. Yes, the company has a right to collect. Debtor has confirmed. And then perform analytical procedures and revenue significant year in say review significant year in sales contracts, as I explained you previously. Based on that, you can do the cutoff, valuation, existence, occurrence. Likewise, you can decide the most suitable assertions. See, determine adequacy of allowance for uncollectible accounts. That means maybe you are checking the impairment or doubtful debts allowance valuation. Directly the valuation assertion. Likewise, you have these objectives. Okay. See, objectives, that means the audit assertions. Here, another important thing you need to know. Okay. Confirmation of receivables. Now, I told you, you are going to confirm the balances from the debtors. Debtor confirmations. Receivables should be confirmed. Usually in an organization, receivables are confirming. You are getting the confirmations from the debtors unless, what are the instances where we do not call confirmations? Accounts receivables are immaterial. There are small amounts. No point of calling confirmations. That effort is useless. Maybe you have other things to confirm the balances. Now, let's say the use of confirmation would be ineffective. Even though you send the letters, there's a high chance that the response rate would be very low. You practically, by experience, you know that no, not effective. It is not effective because all these customers are international customers. There's a high chance they won't reply. Use of confirmation would be ineffective, so you are not using confirmation. The auditor's combined assessment of inherent and control risk is low. Risk is low when it comes to the revenue and receivables, and audit risk can be reduced to acceptably low level with substantive test. Now, you don't have to call confirmation. Risk is also low, so you can cover that assertion, cover that caption, assertions using other things, other procedures. No need of calling confirmations. Right. So these are the instances where you don't have to call confirmations. Now think about this. Now let's say you have called confirmation from debtors, but you have not received the responses. That means the debtor has not confirmed due to different reasons. Or else, because of these reasons, you are not calling confirmations from debtors. Now, how are you going to confirm the balances of trade receivables? Now, let's say there are 150 debtors in the debtor listing, but now you are not going to call confirmations. Calling confirmation is the most reliable thing because the debtor itself, debtors themselves, they confirm the balances. Now you are not using confirmations. Now what to do? The first thing is checking the subsequent settlements. Checking the subsequent settlements. Give me a second. Sub, don't mind my letters. Quant, Q E N T. Subsequent, pasuwa, subsequent settlements. You are checking the subsequent settlements. That means if there was a particular debtor as at the end of the year, if there is a particular debtor as at the end of the year, there should be payments after that date. No? Let's say 31st December 2023, there are 150 debtors. There are different balances. How are we going to confirm these balances? Maybe If the credit period is 1 month, within 1 month or after 1 month also, there should be receipts. There should be data collections. So if you can't call confirmations, you are checking whether there are any subsequent settlements. If there are subsequent settlements are available, that means the balance which was shown as at the end of the year was correct. Let's say 100,000 balance was there as at 31st December 2023. That is the debtor balance. When you go to the audit and check the subsequent settlements, what are the payments done after 31st December, you see 25,000, 50,000 and 25,000. Weekly, there are three payments, three collections from that particular debtor, 25,000, 50,000, 25,000. Total 100,000. That means that debtor has settled the debtor balance fully. So that means that 100,000 balance is correct. That is how we are going to check that. Subsequent settlements. You are going to subsequent settlements. You should check that. One by one, you check that. Or else, let's say the debtor has not settled subsequently. Still 100,000 is there. Now, how are you going to do the valuation correct? How are you going to get it confirmed that 100,000 is correct? You can't do confirmations. You can't call confirmations. You can't check the subsequent settlements because there are no. So now you can originally check the invoice. You can see, okay, whether there are invoices equal to 100,000. So you can check the invoices. So these are the three things you can do for debtor balances, right? Maybe it's not in the slide, but you can write down. The first thing is you are calling confirmation. There can be other things we can do, right? The major things, typical things, calling confirmations. Second one, you are checking the subsequent settlements. Let's say there are no subsequent settlements. That means you can check the original invoices. You check the original invoices. Right, remember that as well, something additional. Okay, now what is the process for confirmation of receivables? Let's say accounts receivable ABC company, there's 220,000 rupees. Confirmation request to ABC company prepared. ABC company is the debtor. Confirmation request is prepared. CPA determines confirmation request is directed to appropriate confirming individuals and addresses. Right. They are checking whether the appropriate addresses have been used to the confirmation request. Now we are requesting confirmations. We are sending a request to confirm the balance. We discussed these things, right? Confirmation request delivered to ABC company. All right. The confirmation request we sent. Now it is delivered by the debtor. ABC company receives confirmation request. ABC company confirming party receives and respond to confirmation request. Now that particular company's confirming party, maybe the finance, now they are responding. Response is delivered to the auditors. Okay, that response is received by the auditors. Can you remember? I told you when you have to think about the originality of the documents, right? Reliability of the documents. These confirmations should be directly received by the auditors, not the client. Bank confirmations also the same, right? Response is delivered to the auditors and then CPA receives response to confirmation request. So this is how you basically do. You are sending a request to the debtor. Debtor is responding if they respond and the auditor is receiving it. So auditor can confirm whether the balances are correct. Right. Now there are two types of confirmations, right? There are two methods of confirmations. Positive confirmations and negative confirmation. Positive and negative. What do you mean by positive confirmation? Request addressed to the debtor asking for a reply. Positive confirmation means The difference in the content is in the request letter, we are writing, please reply us. Please reply us with the correct value. Please reply us with the correct value. That means we are expecting a reply from the debtor. Maybe ordinarily sent with the balances due on them. Let's say, as per our records, as at this date, your debtor balance is 100,000. Please confirm by replying us. That is the normal way. So you are mentioning the debtor balance. So the debtor can check with their records whether it is 100,000. Now they can confirm, yes, it is correct, or I agree, or I disagree. If disagree, what is the amount as per my records? There can be differences as well. No? So that's how it goes. Positive confirmation. Blank forms, maybe even without mentioning the amount, you can send it. Like, we are not saying our debtor balance is 100,000. We are asking the debtor to confirm it. We are keeping a blank request, right? Blank form. Leave amount blank. But it is less frequent. It is less effective actually, because now if we are sending the amount, then if there are differences, customer, that debtor will immediately reply saying, no, 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 this is not the correct amount. This is wrong. That is how the tendency goes. But if you are just keeping the form blank, then there's a less tendency we are receiving the replies. So because of that, we are sending them positive confirmation, but with the amounts, after mentioning the amounts. Right. So what are negative confirmations then? Negative confirmation means ask debtor to advise the auditors only if the balance shown is incorrect. We are writing the balance, we are sending the balance to them, but we are not asking them to reply. We are not asking them to confirm the balance by replying. We are saying, if you do not agree with the balance mentioned on the request letter, please reply us. Likewise, only if the balance shown is incorrect, they will reply yes. What do you think? What is the good method? First one is good. Positive confirmations are good. Negative confirmations are not that effective. Low level of assessed risk of material misstatements. You are sending negative confirmations. Now, you will get the confirmations, you will get the response only if they don't agree with the balances, right? So, let's say in Sri Lanka, can we now 100% confirm we haven't got any response, right? We don't have any responses. So is that does that mean all those debtors have agreed with their balances? We don't know. We don't know actually whether they agree or disagree, whether they forgot to reply us, whether they didn't receive it. We don't know, right? So that is why it's not good. We are using these negative confirmations when the low level of assessed risk of material misstatement. There's a low level of risk. There are only one or two debtors, and we check them actually with the invoices and subsequent settlements. They have fully settled, so no point of calling confirmation, but just a matter of calling confirmations, we send them a negative confirmation. Or large number of small balances. Very small balances, large number. So we are asking them to reply only they disagree with the amount, because we are saying we are getting so many replies, unmanageable. A low error rate is expected. There can't be any errors. So that's why we are sending them just to confirm if they don't agree. No reason to believe the respondent will ignore the request. So we believe that they will anyway reply us if there are any variations, if there are any differences. So those are the two types of confirmations we can call. Right. And now, this is also important. We can use data analytics, right? We can use data analytics for these revenue and trade receivable auditing. How are we going to do it now? This is very popular using Excel and using other softwares, right? We can do data analytics and easily find out different things. We can't do it. We can't do manually effectively. Identify possible fictitious revenue by searching for unusual or large entries of revenue accounts. Now, Through these data analytic techniques, analytics procedures, we can quickly find out using those analytics unusual things or large amounts. Quickly we can find out. Identify possible fictitious revenue by searching for entries into revenue accounts from unusual sources. Through the analytics, unusual sources we can identify. We can do revenue cutoff errors easily because it quickly captures the date issues and everything. If we do it manually, it takes time, but using analytics, within seconds you can do it. Identify related party transactions in the sales journal by selecting unusual transactions. Even the analytics can read the descriptions as well, so they can find unusual like unmatching descriptions or amounts or big amounts likewise, right? Identify possible duplicate billings. There can be duplicates as well. So quickly they can pick duplicates. Possible unauthorized sales discounts. Now, if we tell the analytics tool that the allowed discount rates are 10% and 12%, if there are 15%, 18% discount rates given in the sales report, they will quickly pick using analytics. Possible uncollectible amounts based on the trend, based on the bucket and everything. The analytics tool will quickly analyze and give you the results. See, these are the possible uncollectible amounts, large credits, everything. So very easy, even without human touch, you can use these analytic data, right? And then this is just to refresh your memory. Now we were talking about revenue and everything. So you need to know revenue recognition as per SLFRS 15 and everything. So identify the contract, identify the performance obligations, and then determine the transaction price. And after that, you allocate the transaction price to the performance obligations if there are multiple performance obligations. This is what the standard says. And I always tell you, if you have to do audits, if you are doing audits, you need to be thorough with accounting standards. So, what is the what is our benchmark? Now we are auditing with regards to what? We are checking whether the financial statements are prepared based on the accounting standards. So to check that, right? To check that, we need to know the accounting standards. But we are doing it based on the auditing standards. That's the relationship we have, right? As per our discussion. And then recognize revenue when the performance obligations are satisfied. Only when the performance obligations are satisfied, we can identify the revenue. That is the revenue recognition point, important thing. Right. Next, potential revenue recognition problems. In these situations, there can be revenue recognition problems again. Sales with unusual right to return. Now, let's say, usually when we are selling goods can be returned. As a company, we have to accept the returns unless there are certain items we are not returning. We have to accept returns. Let's say within 30 days, within 5 days, or some in during a period, they have to return the goods with the bills and everything. But let's say there's an unusual right to return. Let's say we are asking a customer, you can return the good within 30 days, even there are no defects. Even there are no defects, you can return the good. That is unusual right to return. So can you actually recognize the revenue before that 30 days pass? It's difficult, right? We don't know at which point that customer will return the good. So potential revenue recognition problems. You have to be very careful when there are unusual return policies like that. Bill and hold transactions. You are billing, you are invoicing, but the stocks are not physically moved. So the physical assets are still, physical inventory items are still with the company. So we don't know actually whether we have uh, performed the obligation, whether we have, see, performed the satisfied the performance obligation, because still the goods are with us. So there can be issues like that. And then multiple element agreements are there. There are in the agreement, there are so many multiple performance obligations are there. So we don't know at which point the revenue should be recognized. We have to be very careful as per the accounting standard, as per the company practice, industry practice. You have to think about those things, right? So those are the problems we might face. Evaluating revenue estimates. Now, I told you there are estimates. When it comes to construction companies, when estimating the uh, percentage of completion, those are significant management judgments are involved, estimates are involved. So, revenue recognition may involve significant accounting estimates like that. So, auditors can evaluate these estimates by, as auditors, we have to evaluate the estimates, reviewing and testing management's method of developing the estimate. We have to inquire the management and ask how you estimated this. What are the things you used? What are the information? What are the basic information you used to come up with this estimate? What is the method you used? Likewise, we have to question them. Developing their own estimate. There means as auditors, we can develop our estimate, our own estimate as well. Reviewing subsequent transactions and other events that provide evidence about the accuracy of the estimate. Now, sometimes we have done an estimate, the client has done an estimate as at the year end. But actually, when you are doing the audit, it is now February, right? 2000 new year, February. Now, sometimes some events have occurred to test the reliability of the estimate. Now you have real time data coming slowly. Now you can check the estimate whether it is correct or not. Likewise, you are checking subsequent transactions. What has happened after that? You are checking the subsequent transactions and see whether it is correct. The auditors are required to perform a retrospective review of the prior year's significant accounting estimates to determine whether they indicate bias on the part of management. It is something like this. Now, previous audit, previous financial statements, there can be estimates used. Now, those estimates are getting realized. The real time information, the real information getting appeared in this year. So, as the auditor, you have to see what are the estimates these management has done in the last year and whether there are any issues with those estimates based on the current year data. Estimate has been done in last year. They didn't have actual information. But now as the auditor, you can see the actual information is here. Now you can see the accuracy of the previous year estimates. Retrospective review means that you are retrospectively reviewing the previous year estimates. So you can check the accuracy like that as well. So you have to see whether there are any changes required. And this one we discussed audit of allowance for doubtful accounts. So you have to calculate this provision for doubtful accounts. You have to review collections in subsequent period. This is the subsequent settlements, right? I explained you subsequent settlements, develop estimate and evaluate reasonableness of management estimate. Now the management has computed their own allowance for doubtful debts. You have to see whether it is correct. Maybe you have to do it, recompute it and see. Compare the details of the aging of accounts receivable to prior year's aging. You can compare the last 2 years aging and see whether there are any differences, whether there are any very old balances. Investigate the credit ratings for and unusually large accounts. There are unusual or large balances. Now you have to definitely see whether these credit limits have been approved properly in the system, whether there are any fake approvals. You have to check them. And likewise, summarize in working paper those accounts whose collectability is doubtful based on the preceding procedures. You have to provide them. Review with the credit manager the current status of significant doubtful accounts. There can be significant doubtful accounts. So with the credit manager, you have to review them because whether to provide more or to provide less, you have to decide it. Likewise, you have to do audit procedures for doubtful debts. So this is an example. The same example we had when I showed you the aging analysis. See, the total receivable balance is here, and then this is the current bucket. That means within the credit period. So, do we need to provide for the current bucket? No, we don't have to because it is still within the credit period. They will pay it, maybe. And then 30 days overdue bucket, 31 to 60 days overdue bucket, 61 plus days overdue bucket. Now, I told you we will have to provide more for 18,000 because it is in the last bucket. They have not paid. We will have to provide more for this. And then provide less for 1,200 compared to 18,000. Provide less for 3,000 compared to 1,200. See, how are we going to calculate it? Current bucket. You take the current bucket first. What is the current bucket total? 188,000. 108,000, 0%. You are not providing 0% and the provision is 0. Give me a second. Right. And then past due 1 to 30 days. Here, this bucket 3,000, you are providing only 10% because still in 1 to 30 bucket, they will pay you, right? There's a high chance they will pay you. We don't know. If they go to the next bucket, we will provide more, 10%. 31 to 60 days, 10% is not enough. We will have to provide more, maybe 20%. So these percentages are not standard percentages, okay? Based on the company's policy, these can be changed. And then this bucket, they are providing for 60%, 50%. Likewise, you are computing the provision and you take the total is 9,000. Now see, what is the client's computation of the provision for bad and doubtful debts? That is 5,000. Client has provided only for 5,000, where as per the auditor's computation, we have to provide for 9,600. So we have to provide more 4,679. Need to pass a journal entry. Now, we can't exactly say we have to increase the provision. We have to first discuss with the management. We have to see their opinion and then after discussing, we can suggest them. If they don't do it, then there will be repercussions for that. You will learn those things after these lessons when you talk about audit reports and everything. How are we going to modify our audit opinion when the client is not agreeing with this? If this difference is very, very significant, maybe we have to modify our audit opinion as well. Qualify the audit opinion or giving an adverse report. Don't worry, we will discuss them later. Right. And then related party transactions. Who are related parties? Now, in a company, there can be parent companies, there can be subsidiary companies. So, there can be transactions in between those companies as well. When there are transactions like that, those are related party transactions. So, related party transactions, there can be different credit limits. Sometimes they are not paying us cash, right? Sometimes when there are balances, we are selling them, they are selling us. Maybe we are setting off those related party transactions. So you have to check them carefully and record them carefully. To identify related party transactions, auditor should review proxy and other filings with SEC and other regulatory agencies, conflict of interest statements by management, transactions with unusual terms. Now, there should be agreements between two parties for the terms and conditions. So, you have to see whether there are any unusual terms. Accounting records for unusual balances or transactions, particularly near the year end. You have to see them very correctly, and we have to disclose them appropriately. So you have to be careful with these related party transactions. We have to show them separately. Right. And then the audit documentation. Anything you do not document is considered as work not done. So if you are doing anything under audit, you have to document everything. You can't say, I did it, but I couldn't do the report. I couldn't document it. You can't say like that. So you have to document everything. First of all, you have to prepare the lead schedule. Lead schedule means what is the total amount, right? Trade receivables or revenue, what is the total amount. After that, you can have your breakups. Breakup 1, breakup 2, detailed breakup, likewise, product wise, month wise, sector wise, different breakups can be there. Now, debtors also, first you take the accounts receivable total. After that, in the next slide, next tab in the Excel maybe, you can show the sources of accounts receivable. Can you remember our first slide? There can be different sources, trade receivables, refunds, tax refunds, advances paid to suppliers, different things. So you are showing the breakup. And if you take trade receivables, there's a breakup. So you are showing it again. Likewise, lead schedule and then the breakups. You have to show it. And also for revenue. Prepare working papers for, you have to prepare working papers for aging analysis and then analysis of other accounts receivables, those funds, those advances, everything. And then analysis of allowance for uncollectible accounts. Maybe you have done the provision separately. This is client's one, this is my computation, this is the difference. Likewise, you have to show separately workings. Comparative analysis, you can compare this year revenue with last year. This year month-wise revenue with last year month-wise revenue. Month you are comparing. Product-wise revenue you can compare. Industry-wise revenue you can compare. So you can do comparative analysis. Documentation of internal controls. Obviously these come first. Before doing substantive procedures, you have to do system study. That means you have to understand the revenue cycle. You can understand the industry. You can understand the client. You can record these things. You can do the, you can understand the controls placed in the company. So you can list them. And after that, you can do the test of controls, separate workings. You can do substantive procedures. When you do substantive procedures, you have everything like this. Risk analysis and audit plan, these come first actually. Before coming to these revenue, you have to plan it beforehand. Likewise, these are the audit documents relevant. Okay, so with that, we have come to the end of today's lesson. So in this lesson, we discussed in detail the caption of revenue and accounts receivable, right? One caption from statement of financial position and revenue from the income statement. So we discussed what are the procedures we have to follow. Risk assessment, how to do it, test of controls, what are the examples. I gave you plenty of examples, and what are the substantive procedures, how to do audit documents, what are the risks happening, what is the importance of revenue recognition. All these things we discussed. And at the end of the lesson, there's a question and you can answer them as well. Answers are also there. So if you have any issues, you have my email address. You can email me with those questions, specifically with those questions if you have any doubts. Because if we are in the physical lecture, you can clarify them, or you can clarify in the lecture hall as well. But if not, you can send me a text message or WhatsApp or email. You can clarify those issues. Right. Okay. So before winding up this session, I want to explain a very important thing. It's about your group assignment. Now in this lecture, in this lecture series, in this subject, you have a group assignment, right? Now, what is the group assignment? There are topics. There are 20 topics here given in your course manual actually, right? In this 20 topics, 21 topics actually, we have your name list, right? For all three departments, accounting and all other two departments, we have the name list. I will be getting those name list group wise. Maybe there are 8 to 10 members for each group, right? I will allocate these 21 topics randomly for the groups, your groups. So you will get one of the topics mentioned here. I don't know, I will randomly allocate these topics to your groups. After that, I will communicate the topic to you within the day, right? I will communicate it, I'll upload it in the LMS as well. You can see what is the topic you have got, right? What is the topic your group has got. What you have to do is this. As the group assignment, you will be allocated one of the following contemporary issues in auditing and assurance. All these are related to auditing and assurance. You should select at least 10 recent key research articles published after 2010 on the selected topic or the given topic. That is the task you have to do. When you get the topic, you have to search for 10 research articles, journal articles, 10 research or journal articles published after 2010. Published after 2010, right? So you have to select 10 and it should be like those should be good articles actually from reliable sources. All these will be mentioned. I will upload the guidelines how to find the good articles actually. No අර නිකන් articles නෙමෙයි. හොඳ source එකකින් ඔයගොල්ලෝ හොයාගන්න ඕනේ. I will show you how to find the reliable journal articles. After finding the 10 articles, you need to submit those selected 10 articles to LMS before next Wednesday. That is the major requirement. Before next Wednesday, you have 1 week to get the topic. I will give you the topic today, right? I will give you this message separately as well. You have to select the 10 articles and you have to submit the 10 articles to the LMS. Ajwat sir will open a link separately. You have to upload it. You have to upload, you have to submit the 10 articles as a zip file, right? Not one by one, zip file with your group number. With your group number as a zip file, you need to submit to the LMS. That is before the next Wednesday. Deadline is next Wednesday. That means today is 15th. 22nd, right? 22nd, by 22nd May, you need to submit the articles. Because we have to see whether your 10 articles are actually serves the purpose. That's why we have to check them. That's why. After that, we will confirm you the journal articles. After that, you need to prepare a report on synthesizing the findings contained in them. Similar, like simply summarize. You have to read the article, you have to analyze it, and you need to summarize the findings of those articles. That is all about it. So that is not a presentation, it's a report. It's a group report. So a group could consist of a maximum of 10 members. I will take care of it. And here, report content is also given. The report should contain the following: introduction to the report, you need to write an introduction. Analysis of the selected research articles, you need to analyze the 10 articles. The synthesis of the main findings, summarizing the main findings. Conclusion, references and appendixes in if any. Formatting guidelines are also given. Maximum you can go up to 15%, 15 pages, excluding references and appendix. The first page should have group members' names and index numbers, very important. First page, you need to show the group members' names and index numbers. A4 size page, 12, font size is 12, font style is Times New Roman, line spacing 1, margin left 1.25 or other 1. You have to be very careful with these formattings. We are strictly checking those formattings. And the reference style. Why? Now you are doing this assignment. You are preparing this report with the journal articles. So you are quoting, you are getting the information directly from the journal article. You can't write, you can get those details without quoting them, without giving the due respect, due reference to those authors. You can't quote anything. That's why you need to use a reference style, Harvard, right? Harvard reference style you need to use. Submission deadline. Now, this is important. Even though we have mentioned in your course outline at the end of this semester, we are not very sure about the date actually. So, let's say 21st June. For now, the deadline is 21st June. I will send you the details anyway with another sheet. I'm just explaining here 21st June will be your deadline. Soft copy of the assignment should be submitted again to the LMS. A link will be opened. Online version upload to the LMS under the subject. Yes. And then reports after the above deadline will not be accepted for any reason. And special note, plagiarism will not be tolerated. We are strictly checking the plagiarism of those submitted reports because we all aware that there are artificial intelligence tools, AI tools, ChatGPT, Gemini, any other tool, we know those things. So that's why you can't use plagiarism for that. Do a genuine job, right? You can't use plagiarism, right? Here, you can't not use plagiarism. Don't get caught for plagiarism, right? That's it. Okay, so those are the guidelines coming under a group assignment. So I will anyway send you the details again, and I will inform you the topics each group has been allocated. Right. So with that, we can wind up this lecture. Thank you. If you have any questions, as I mentioned earlier, you can contact me and clarify them. Goodbye. Thank you.